Joining us now for a closer look at the markets as we start 2026, Stephanie Link, Hightower Chief Investment Strategist. Steph, good morning and Happy New Year.
Good morning, Mike. Happy New Year.
So here we are. Obviously, a third straight, pretty strong year. The latter part of 2025, you started to see a little bit of that rebalancing of the market, tech underperforming, cyclicals doing better. What are your broad expectations for how things track from here?
Actually, I think 2026, we could see an acceleration, Mike, in the economy, not only from the consumer, which has been resilient, and we've been talking about it all last year, and the AI momentum, but now you have this year, you have more fiscal policies coming into place with the One Big Beautiful Bill, which will help not only the consumer, but corporations. You have bank lending, which is really important. The H8 data from the Federal Reserve, we've seen 10 consecutive weeks of acceleration in loan growth, and that will help to fuel the economy as well. Deregulation, M&A, and also we know that the Fed cutting, it's always a lag of impact. So I think as the Fed continues to cut, and I don't know if they're going to be very aggressive, but it should be a positive as well. So I think it all sets up for continuation of good earnings. Last year, earnings grew 14%. This year, I think you're going to grow about 10 to 12%. With revenues in the mid single digits. Margins will continue to be strong, and you have continued buybacks. And so I think 2026 sets up well, but I am mindful that we've had 3 amazing years in the S&P 500, double-digit growth, and to have a repeat again, it might be a bit challenging. So I'm kind of expecting like 8 to 10% growth this year.
Yeah, I mean, especially if we're talking about a broadening of earnings growth, if that does come through, as a lot of the consensus would have it, sometimes that doesn't have the most high leverage effect on the S&P 500 as we've been seeing, right? So, it could be a little bit lost in the wash. Where are you finding maybe individual opportunities? Because there was massive amounts of dispersion within the market last year, a lot of push-pull, even within the Mag 7. So where is that taking you?
Yeah, so I think first you want to own some of the laggard techs. And that would be, in my mind, Meta, and we can go through it. You also want to own economically sensitive companies like Union Pacific, some of the rails, which have actually lagged in the past year. You definitely want to own automation. That is in the early innings. That's like a Rockwell Automation. You want to absolutely continue to have exposure to consumer. I like it via Capital One or even something like an Estee Lauder. And lastly, I've been a big fan of animal health. Zoetis was down 23% last year. This is an industry leader with 20% market share. So I think there's opportunity there.
Talk a bit about Meta. Obviously, there's been a lot of, each of these AI players, the hyperscalers, whatever you want to call them, have run hot and cold in investors' minds, and it's 17% off the high.
Yeah, and that's one of the reasons why I like it. It's 17% off the high. It's trading at 23 times earnings, and you're getting 20% earnings growth and 26% revenue growth. And I think 2026 sets up well for Meta because they have been spending so aggressively. And so AI is going to lead to better tools, new customer applications, messaging improvements. And also you have this cost-cutting program in Reality Labs that could be something like $5 billion. They have a $31 billion buyback. And I think there's a possibility you can see $38 a share in earnings power by 2027. So I think you add it all up, the fact that stock has lagged and people are mad at the company for spending, I think that spending is actually leading to better ROIs. We saw it last quarter with impression growth of 14% and time spent up 5%. So it's working. We don't like them spending that much, but it's working. And eventually you're going to get better operating leverage.